Hello, everyone, and good morning. Thanks for being with us today here. 2024, what a difference a year can make. We were here exactly 1 year ago, and Bitcoin was at $28,000. And a lot has happened over the last year. Now, Bitcoin is close to $60,000, even though down 15-20% from its recent peak, but still up over 100% from last year. And Bitcoin's quadrennial halving had just occurred. MicroStrategy now holds over 214,000 Bitcoin, which is more than 1% of all the Bitcoins that will ever be in circulation, currently worth close to $13 billion. And we have participation and support from big institutions like Fidelity, BlackRock, Galaxy, Bitwise, ARK. They all now support Bitcoin, and combined, all the spot Bitcoin ETFs hold over 800,000 Bitcoins. So it is said that arrival of spot Bitcoin ETFs is one of the biggest development on Wall Street in last 30 years. Today we have a fantastic panel of some of the top research professionals in the digital asset space with us here today. So my first question to the panel is, how are Wall Street and Bitcoin getting along together? How has the institutional acceptance and landscape evolved over the last 12 months? Chris, you want to begin?
Sure. I think how are they getting along? Quite well, obviously. It's, as you said, not only one of the most successful Bitcoin products out there, but one of the most successful ETF launches compared to all ETFs, whether you're looking at volumes, time to AUM, thresholds of different amounts, longest day streak of flows, inflows into it. Absolute success. And I think even all of us here were blown away by it. I think we were expecting a hot start, but I don't think anyone was expecting the flows that came after it. And so when I look at this, I see, even though Bitcoin is absolutely unique, which of course you heard in the previous talk, there is no other thing like it. In terms of it as an investment, I think it's following the same track as a lot of other things. So I used to be an equity analyst. I covered REITs at one point. Real estate investment trusts, those weren't even a thing until the 90s. And now, of course, everyone has them in their portfolios. They're obviously a great diversifier, and that's, as they say in finance, the only free lunch. If you can add something that's not correlated to all the other things, you can increase your risk-adjusted returns. And so I think it's following the same path. Well, just as REITs had to go through this process of financialization, Bitcoin is doing the same thing with these products. And so I think you're just going to see more and more of this, but I think it's going to take a lot longer to play out. But it's a slow burn. There's a lot of demand. A lot of these products still aren't on platform. They still have to go through the compliance. So to me, the bigger story is not the big splash that they made, but actually this long tail of 12, 18 months where I think you're just going to see this continual bid for these products over the next couple of years.
I totally agree. I think it was a smash hit. It's probably one of the most successful financial products ever, these Bitcoin spot ETFs. And we were just talking about this backstage. All three of our firms have one of these. So collectively, we have experts in ETFs, both operating them, marketing them, and still, I think, shocked at the amount of volume. I think 13 billion in net inflows in a basically 2-month period, all without the main net new addressable market that I argue these are actually for, which is financial professionals who had no other way to buy Bitcoin. We can all buy Bitcoin. Michael Saylor and MicroStrategy and Shirish, they've been able to buy Bitcoin. They didn't need the ETF. I've been buying Bitcoin for years. I didn't need it. So we said, who is this for? And it's for professionals who can't go to a crypto exchange and buy it either for themselves or their end clients. There's not sub-accounts. It's not integrated into their advisor platform and technology. So the ETFs are powerful for that. And just to be clear, right, ETFs are a brilliant financial product separate from Bitcoin. You can wrap anything and have it trade through the most liquid, deepest capital market infrastructure in human history. I mean, you can put gold in it. You can put a basket of equities in it. You can put basically anything in it. You can put spot Bitcoin. So I was blown away too. The other thing I wanted to say is, like, when we think about Wall Street, because I worked at Fidelity, people used to say, oh, you work on Wall Street. I said, that's not fair. We work on Summer Street in Boston. It's very different. But when I think of like Lower Manhattan active trading Wall Street. I think of hedge funds primarily and global macro traders. And they were already very interested in Bitcoin for its fundamental properties and for its trading characteristics. It's relatively uncorrelated and all those things. But they're becoming much more interested. It's on every screen when I talk to people that literally trade rates and fixed income securities. They also watch Bitcoin. When gold is up, they say, wow, gold is up. What did Bitcoin do today? That was happening before the ETF, and it's only accelerating. So I think it will continue to accelerate over time, that Bitcoin is a macro asset.
Yeah, I mean, I completely agree with what Chris and Alex have said here. These spot Bitcoin ETF launches were the most successful ETF launches of all time. ETFs have been around for 25, 30 years, and we haven't seen anything like this in its history. And I think, it just goes to show that there was a lot of demand for Bitcoin that could have accessed the markets in a lot of ways before, but didn't. I think, now Wall Street has that regulatory stamp of approval on spot Bitcoin ETFs, through spot Bitcoin ETFs on Bitcoin as an asset, and that allows them to, de-risk from a career perspective a little bit and say, look, we want to understand this asset, we want to allocate to this in our portfolios or on behalf of clients, and it also allows, retail traders, people that are investing in Bitcoin through their retirement accounts to also feel the same way, like, look, maybe this won't be regulated into non-existence like the mainstream media likes to say, or maybe Bitcoin, isn't going to die like the mainstream media has said hundreds of times before. And so I think Wall Street and Bitcoin are really getting along well, and it's really impressive to see the demand that we've had so far. But I agree that we're only seeing the tip of the iceberg, and I think there's a lot more demand underneath the surface that will unlock in the longer term future as we get more approvals and we have more institutional investors coming around. So it's really exciting. I think spot Bitcoin ETFs are really Bitcoin's IPO moment, and it's really early in Bitcoin's life cycle still, and for institutional investors to gain adoption and Wall Street to adopt Bitcoin. So it's really exciting to see what they're doing now with Bitcoin, and the conversations we're having with Wall Street are definitely more positive than they were this time last year or the year before.
Do you have any examples of how the conversations were in the past and how they have evolved now?
Sure. Yeah. So at Bitwise we have a large sales team that goes around, and they're dialing for dollars and knocking on the door of financial advisors and RIAs and institutional investors all around the U.S., trying to explain to them why Bitcoin belongs in a portfolio or help them on their educational journey. And I think a year ago, beginning of 2023, particularly the last 6 months of 2022, those conversations were really hard to even get started. We were, ignored by a lot of financial advisors, ignored by a lot of investors who really thought that Bitcoin was going to go away or was dead. And so what we've seen in the last 12 months or so, really since BlackRock, applied for spot Bitcoin ETFs and we started to see the markets turn around and a lot of optimism for these ETFs to be approved, we've seen, a lot of inbound calls into our organization looking to get educated on Bitcoin, trying to understand how it fits into a portfolio, how they can access it, how it's custodied by ETFs. And so those conversations went from us knocking on doors and having the door slammed in our face to institutions knocking on our door trying to understand how they could get access to ETFs. So it's been a really great shift, and those allocations that were less than 1% for some advisors who were pro Bitcoin before the ETFs are now 3% or 5%, or in some cases 10% of the portfolio. So I think we're just continuing to ramp up over time, and it's great to see.
I have one too. We was talking to like a top 15 asset manager, like by AUM in 21, and we'd give a big presentation, and they were like, "That was a great presentation. We really do think Bitcoin is digital gold." And we were like, "Sick! That's great. That's what we were saying." And they're like, "Yeah, but we don't invest in gold, so we're not going to invest in Bitcoin." They're like, "You guys did great." And then fast forward now 3 years later, the macro picture has also dramatically changed since then. I think people may not be aware, but what used to be something that only gold bugs talked about, the unsustainable national debt, the federal deficit, the strength of the dollar or relative weakness of the dollar, other currencies. Sure, Ray Dalio has been talking about that. Stan Druckenmiller has been talking about that. But now everyone is talking about that. The unsustainable nature of the government's debt situation, not just the U.S. government, I mean, most governments, is a huge, huge issue now. Maybe it's come to the fore because rates are so high, and so it's pressuring This is something that everyone is concerned about. Jamie Dimon, no fan of Bitcoin, but also the big CEO of the world's largest bank, he has been saying that it's unsustainable and something has to give. Federal Reserve Chairman Jay Powell, who has been criticized for a long time for never discussing the fiscal side of the equation, which we understand the Fed doesn't want to be seen as political and pressuring the executive branch, right? They're supposed to just stay in their lane. He said on 60 Minutes, they said, how does this get solved? He's like, I don't know, it's not tenable, right? And so that has caused, when I think back to this asset manager, they are now looking at things they did not invest in 2021, not just gold, but Bitcoin again, but also they kind of had a team to look at Bitcoin and crypto assets in 21. Then the market fell out and they were like, well, let's focus on other stuff. And now they're like, oh no, we're scrambling to like start doing the work again. So it is still slow going.
Yes, on the topic of gold's comparison, not many people are familiar, but if you look at 1970s gold price fluctuations, I saw a chart from Morgan Stanley that showed the correlation, and gold was the Bitcoin of 1970s, and it used to fluctuate similarly with similar type of volatility. And just, as the asset class matures, it kind of stabilizes. So that's one of the things on the comparison. So what are the type of institutions you are talking to? Who are these institutions, and what are the type of conversations you're having? So, and any insights on the nature of the companies or corporate or institutions that are looking into, taking positions or taking position now?
Sure. Yeah, we have our own clients, institutional clients that we have our direct business with. But we also do a institutional survey every year at Fidelity Digital Assets, and you can find this on our website for free. But it's really interesting. We've done the 5th year in a row now, and consistently what you see is a very high number, 80+% of all of those surveyed, and again, these aren't our clients, it's over 1,000 people worldwide, say they own or are invested in digital assets. And then you say, well, how come, if they're all here, if the institutions are here, why are we still a $1-2 trillion asset class? And you dig into the numbers and you realize it's kind of a big barbell story, where the high numbers, 80+%, are high net worth individuals, family offices, multifamily offices. And then on the other end, at low single digit adoption, are the big gorillas, the big money, the foundations, pensions, endowments, those sorts of things. And so really, I think it's just a matter of time and also kind of bureaucracy. The individuals, the high net worths, the family offices, it's usually one person leading the charge, we've found. They've come onto the thesis, they are well informed on it, and they say, we want to make this a core position, and they can just go and do it. And then, of course, all these other institutions have a board, they have a lot more red tape. And so that's why the ETPs, the exchange trade products, they're the biggest story here, because now before, where they would have to carve out all these special exceptions, if they're already set up compliance-wise to buy a stock or an ETF, they can do so. So I think that's one of the biggest changes, and we're starting to see a little uptick in the number of the big money there. And so I think that's the story we're watching going forward, and we'll continue to do the survey and see where we land. And obviously, it'll just be shown in the price as well, in the market cap.
Yeah, so a lot of this adoption so far has been driven by like champions in the respective companies and driving the adoption. And now I think the message is coming more broadly that the companies, the managements need to look into it, and they cannot just stay silent and stay on the side. They need to look into it. So what are the type of companies that are lagging behind, you feel like, that are still staying on the sidelines and not participating? Or like, what are the kind of hurdles that are keeping them away?
Yeah, I'll just quickly say I mentioned the foundations, pensions, endowments. Those are the ones that are lagging. The survey also covers what's your biggest hurdle.
Yeah.
And number one is always volatility, or at least near the top. And this one, I think it's just, not to be hard on him, but a convenient excuse. And so if you look at volatility, I'm sure we'll talk about this more, all these funds, they own things like Netflix and we just ran a study. Bitcoin is no more volatile than a lot of mega cap stocks, Tesla, even Meta, just to name some as examples. And so if they own those, but they don't own Bitcoin, I don't really see that making sense. It's not about the volatility. I think it's just an excuse. And if it's volatility, if you're a professional money manager, well, then the answer is risk management, position sizing. You should know how to handle this. And then, of course, there's all the other things, fear of regulation, some things still about the security. But what I've noticed over the years is the excuses are getting more and more sophisticated, if you will. Like there's a little bit more there, whereas before they were just kind of the same old tropes of bad for the environment, it's criminal money, those sorts of things. So we've made progress, but we still got a little ways to go.
Yeah, and 13 Fs have started to come out, not fully out yet, middle of May. So how is the breakdown, like how much of this demand so far in the ETPs, like institutional versus retail? Ryan, I think you have done some work on this. Would you like to elaborate?
Yeah. So the 13 Fs, which are filed by wealth managers that manage over 100 million in assets and show what they're invested in, and those have started to trickle out. I think May 15th is the final deadline. But what's been interesting to see there, and I think what is surprising a lot of people, is that there aren't these gigantic firms that have come out and said that they're buying Bitcoin. It's really the littler firms, the smaller financial advisors or RIAs that can move a little bit faster, and retail investors that can, they're self-directed investors and they can buy whatever they want as long as it's on the platform they use. They're the investors in these spot Bitcoin ETFs today. I like to use the analogy of, the bigger the firm, the bigger the boat, the slower it's going to move to adopt these things. And you have these more dynamic and more agile, wealth managers who are generally the first adopters to new assets like this and newly listed assets like this. And so, we speak to a range of wealth managers, from independent financial advisors to large RIAs to pensions. And I think we're starting to see a tipping point that Chris kind of mentioned, where before you might have one person in the room who is a fan of Bitcoin or at least has studied Bitcoin, but the others in the room are just anti-Bitcoin. They haven't spent time learning about it. They don't believe it belongs in a portfolio. They think it's going to zero or it's going to be regulated away. And now we're seeing maybe 2 or 3 people in the room, maybe 25 to 50% of the room being educated on Bitcoin, believing in Bitcoin, fighting for Bitcoin to be in these portfolios. And they're just having to work to get the investment committee or the risk managers at the firm to really start believing in Bitcoin. And that's when we'll start to see that corner turn. But for now, it's RIAs that can move fast. There's financial advisors who are independent who can move somewhat fast. And then there's self-directed retail investors. And I think a lot of the demand has come from self-directed retail investors in the first 3 months of these trading. And that's really impressive given the growth of these funds that we talked about and the amount of assets that have flown into them. And it's also very optimistic for the outlook of how large these funds can grow. And it's not just about the size of the fund, it's about the impact that inflows into these funds have on the price of Bitcoin. And I think that we're sitting in a really optimistic place, despite the fact that the price fell 20% over the past week or so.
Yeah, can I just point out too that if you look at the prior bull runs, like I think 2017 had 22% or more drawdowns during a run from $1,000 to $20,000. 2021 from December 2020 to like April 2021 had something like 8 or 10, 15 to 20% draw. It's actually totally normal in a bull run. It's what they say, climbing the wall of worry. I would say to the question specifically, I absolutely agree. I think we, like I said before, we looked at wealth managers and financial advisors as the obvious target market for this product, and other institutions that can't easily, go on Cash App and buy Bitcoin. And they take a while to turn on. Many of them aren't even allowed to consider adding an asset to their platform for 90 days. They need a seasoning period, and then they got to do a bunch of diligence. So we always knew that. So then in the first 40 days to have what we had, this just record inflows, we assume and know that this is mostly on the brokerage platforms. It's on Fidelity.com and Schwab and TD, where anyone that has an account can basically buy any ETP or security. And that is very bullish because that market that we sized, and I've heard different estimates, James Seyfarth and Eric Balchunas have a slightly different estimate, but we peg the US wealth management and financial advisor market at 40 trillion in AUM. It's between basically bank platforms and broker dealers. Some of them may allow on an unsolicited basis today, a client, if you call up your financial advisor and you pester them enough, they might let you at small size buy the ETPs. The vast majority won't allow you, and none of them are currently actually suggesting it or offering it. That's what's happening now. So we got 13 billion in net inflows, and I don't know, where did we start the year? Like in the 40K range. for Bitcoin price got to 73.8 and 13 billion without any of that market. So I think there's a lot to come for that. And I would also just say in terms of the types, you know, do I feel bad? Someone was like, oh my gosh, like you should have been telling us to buy Bitcoin earlier. I'm like, do you listen to what we say? I've been saying to buy it for years, right? And I'm like, I was the one, and many of, I'm sure all three of us were saying buy it at 16.5 at the start of last year. And they didn't, and the institutions were still, you know, some of them were literally burned from venture investments that went poorly in the crypto ecosystem, or rate hikes causing some turmoil in their portfolio generally, and so they had gone away. And then Silicon Valley Bank collapses, Bitcoin rises a lot on that event in March of last year, and then BlackRock files for their ETF, and then we all and everyone else followed suit immediately, refiling, and then Grayscale in August wins this court case that, for close watchers, and of course it ended up being true, we all said, wow, this I think might make the ETPs inevitable. That was when they were like, let me pick up the phone and call, let me like restart the conversations, and then that was at 28K last August, and they're like, maybe let me poke around, I guess Bitcoin isn't dead. Then at like 35K in October, they're like, we really need to start working on this again. And then at 50K, they're like, why haven't we gotten into this yet? And now they're basically, a lot of them are literally racing to go through whether it's onboarding or diligence on the asset itself or the ETPs. Like there is they're not deterred by $57,000 Bitcoin.
And so those people may find it cheap now, off 20% from the high.
Honestly, yeah, the institutional investors are typically relatively savvy investors. They'd prefer not to buy right at like the all-time high in general.
Yeah, I would just add to that, you know, you have these wealth managers, a lot of these financial advisors, right? They're having to answer to clients when Bitcoin doubles, triples in a year. Why don't I have an allocation of this in my portfolio? I'm paying you to manage my investments, yet you missed one of the best performing assets ever, and especially over the past decade. And how did you do that? And so it's either because they ignored Bitcoin or they couldn't access it. Now a lot of them can access it, and now it's impossible for them to ignore it. And it's really a business risk for them to not do their due diligence and learn about Bitcoin, because if a client's knocking on their door saying, hey, I want to invest in Bitcoin, and they're saying, no, we're not going to let you do that, they're just going to go find another financial advisor, and that advisor is going to lose business, they're going to lose revenue. And so there really is this grassroots demand that helps drive Wall Street's adoption, and that comes from clients and individuals who ultimately are paying these wealth managers to, you know, grow their assets. And if they're not investing in one of the best performing assets that we've ever seen, then they're not doing their job, and they don't deserve to be paid for it, is the view of the clients. And so I think that's going to help push forward adoption and accelerate it in a way we haven't seen before.
So on the topic of price, Bitcoin's halving just happened 2 weeks ago. It was the fourth halving in the history of Bitcoin. It's a big milestone event in the protocol's journey. How do you expect this halving to impact the supply-demand economics? And prior halvings have shown the price to rise dramatically after 6 to 12 months after the halving. So how do you expect this halving to behave? And I'm sure you've done a lot of research on this topic. So can you elaborate like the demand-supply economics, and how do you expect the price to behave?
Yeah,
and would it be different than the prior cycles?
Right. From my traditional finance background, you're supposed to never say the four most dangerous words in finance. This time is different. However, this time is a little bit different in that we hit a new all-time high before the halving. That's never been done. And of course, a lot of that was on the anticipation of the approval of exchange-traded products. So that was definitely demand-driven. But I'm still in the camp. A lot of people look at that and they say, see, it's already getting priced in. More people are aware of it. I'm personally still in the camp that you cannot fully price in the halving for two reasons. Number one, it's basic supply and demand at its core, Econ 101. If you're cutting the supply, the new incoming supply in half, it's the equivalent of some whale coming in every day and buying 450 coins regardless of price, right? So that has to have an effect. Now, whether or not that is in the short term fulfilled by other people, and that's what we're seeing right now, you can see in some of the on-chain metrics that these long-term holders, this time is different. We've never had 70% of all Bitcoin hadn't been moved in over a year going into the halving. That was an all-time high. We've never had that before. And now with the bull run of last year and then coming into this year, we're seeing some of those long-term holders move their coins, so probably sell. So they're fulfilling some of that supply that's been cut. But over the long term, I don't think you can front run that amount of supply, that no one has that much capital. And the other reason I think it can't fully be priced in is we have a pretty big publicly traded miner market now. And so as a thought experiment, if the price of Bitcoin went to $1 million tomorrow, the publicly traded miners, their margins would be absolutely massive. So if you're a capital allocator, are you going to say, oh, I want exposure to Bitcoin, I'm going to go buy some spot Bitcoin? Or are you going to say, wait a minute, these miners their profit margins are huge, I'm going to allocate to that. And so there's going to be kind of an ebb and flow and an equilibrium between these two things. And so, of course, the problem, though, is we don't have a way to separate which is driving it, supply or demand. And the demand side is, of course, absolutely huge this time around with the exchange-traded products. And so we can't disentangle them. And then we also don't have a counterfactual every 4 years as to whether or not this is being driven by liquidity. So far with each halving, we've had these liquidity cycles where the Fed's printing or easing more. We have an election year perhaps, and we might get that again this year. And so we still might not have our answer of which is the bigger driver here. But to me, I don't think over the long term, anything can happen in 6, 12 months, but over the long term, over the next couple of years here, I don't think it's fully priced in and it's still gonna have an effect.
Yeah, I think it's really a story of supply and demand. If you boil it down to the most simple point, it's, is there rising demand? Is there falling supply? With the halving, we have new supply falling in half. We clearly have this tidal wave of demand coming into the market, and I think, which it sounds like we all agree on, is yet to be seen because of all these platform approvals and these committee meetings that happen, months, even years out from when these assets are approved. And so you have all of this incoming demand, you have this reduction in new supply, and that's great for the price, but the halving is also this great marketing tool for Bitcoin that comes around every 4 years and really brings attention back to the core focus of Bitcoin, which is it's an asset with a hard cap, limited supply, and we know what the schedule of that supply is going to be until it reaches that hard cap. And so yes, it's great that the new supply is falling in half. That's definitely a impact on the market because you have less selling pressure coming. It's great that we have increased demand, but it's also great that the world continues to wake up every 4 years to what Bitcoin is, its fundamental design, how it's different from traditional currencies, and why it does demand attention from investors.
I just want to add on your last point, Ryan, too. I think I totally agree about the supply demand, and obviously from a supply standpoint, the potential impact of it halves every 4 years. So, when 50 coins are being produced per block prior to 2012, and it halves to 25, that's in absolute terms a much bigger impact. I think somebody put out a good chart, maybe not someone on the stage, and so not us, so I'm not going to give them too much credit, but if you look at the actual supply in dollar value of Bitcoin that's produced every day, or the reduction compared to the daily float of 10 to 30 billion of the asset, it's a tiny percentage, right? So it's not, so I agree with this point, but yet it still does matter. But to your point, the second part, the marketing point and the uniqueness of Bitcoin, there is no asset with as credibly neutral and transparent and predictable a supply as Bitcoin in the world, in the history probably of humanity. It's cryptographically provably scarce and gets scarcer every 4 years. And I think that learning about the halving is one of the best ways to learn about Bitcoin in general. And that happens. And now you've got Fidelity and Bitwise and Galaxy, but also BlackRock and big financial advisor platforms, Invesco, who we partner. I mean, big, giant asset managers putting out pieces about the halving and about how Bitcoin is unique and different. So as a quadrennial marketing event, I think it will always matter.
Great. So switching to the mechanics of the ETPs, I think a lot of people are very curious about, how does the process work in a life cycle of like a day in ETF? You see some demand coming, people hit buy button on BitB or FBTC or anywhere. So how does it work? Because there's demand coming, and then do you buy it all together? And how does that work during the day? And how do the APs enable the create and redeem process in the background Would you like to elaborate? I think Ryan. Yeah.
Sure. Yeah. So there's a lot that goes into the weeds of how these ETFs work. Fundamentally speaking, when a dollar comes into the ETFs, they go out and buy a dollar of Bitcoin. Now, there's again things behind the scenes that are happening. You have kind of three parties at play. You have the ETF issuer, like a Bitwise or Fidelity, and sitting in the middle. And then you have APs, which are authorized participants that are regulated broker-dealers, large financial institutions. They strike agreements with ETF issuers. They're the only ones that can actually receive shares of the ETF directly from the issuer. And then you have OTC desks, which are on the other side of the arrangement, who go out and buy and sell the Bitcoin and kind of deliver it to the ETF issuer on the other side. So, a typical flow on any given day, these ETFs trade any day that the stock exchange is open. And if there's $1 billion worth of demand coming into the ETFs, the authorized participants would contact the ETF issuer and say, hey, I want to buy $1 billion worth of shares of the ETF. And then they would send the cash for those shares to a cash custodian like BNY Mellon. And on the flip side, the ETF issuer would go out to the OTC desks, and us at Bitwise, we partner with a variety of the largest OTC desks to get the best quote you can get on Bitcoin for that purchase. We find the best quote, we enter an agreement to buy Bitcoin, $1 billion worth of Bitcoin from them. Once that Bitcoin is delivered to the crypto custodian, which for most of the ETFs is Coinbase, which generally takes about a day to settle. Once the ETF takes economic ownership of that Bitcoin when it's delivered to the crypto custodian, you let the cash custodian know that you've received the Bitcoin. They release the shares, to the authorized participant, and the ETF issuer receives the cash and settles the trade with the OTC desk. So there's these moving parts that are happening, but fundamentally this works just like every other ETF works. This isn't something new for Bitcoin. There's a bit of a nuance under the weeds, whether you have in-kind creations or cash creations. The current SEC regime said that they only wanted cash creations, which means that the authorized participant has to deliver cash for those shares. If they allowed in-kind creations and redemptions, then they could just go out and buy Bitcoin and deliver that directly to the ETF issuer. So it creates a little bit of inefficiency and a little bit more complexity with this cash redemptions and creations process, but ultimately this is how ETFs work, and that what I had described was inflows of assets into the funds, but the same process would unfold in the reverse order when flows were, if they're flowing out of the funds. So that's the process. Hopefully that helps paint a picture of how it works. And
so if there's $1 billion of buy order, is it done during the market hours? Is it concentrated towards the close of the day, or how does it work? And is it only on the weekdays? So there can be some predictable patterns from there, but is there anything out there on how does it work? Means if there's $1 billion demand, it can move the markets also, and there has to be enough liquidity. So how do you handle those tensions?
Yeah, it's a good question. So working with these OTC desks like Falcon X, for example, or Jane Street, right? They specialize in trading assets and getting the best pricing for those assets and not moving markets too much with large liquidity orders, buy and sell orders. And so they're really focused on that element of it. But certainly, there's not too long of a delay between when those assets come in and when the Bitcoin's purchased. That's why, we certainly see the price of Bitcoin moving. Oftentimes, I think there's been a high correlation between market hours of the stock exchange and the price, certain volume around Bitcoin since these ETFs launched. And so it can impact the market. That's the nature of the beast. These are basically funnels for dollars into Bitcoin. And if those funnels have a lot of dollars coming in, that's going to ultimately push the price up. But OTC desks are very sophisticated. They trade all kinds of assets. Jane Street doesn't just trade Bitcoin. They trade all kinds of financial instruments. And so they really specialize in doing it in a way where they get the best pricing for the customers and they don't move markets too much intentionally.
Alex, you have a lot of experience with APs.
Yeah, Galaxy, I think, is the largest OTC crypto derivatives desk. I'm quite certain that we're also one of the biggest spot OTC desks, and we trade with everyone from endowments and pensions, although like we've talked about, they're slow to get back in the saddle, hedge funds, high net worths, other institutions, and ETFs, right? The ETFs, to Ryan's point, they're not logging into a Coinbase account and hitting market buy when they need Bitcoin, right? They have much more sophisticated arrangements, and One thing I'll point out is that whether it's the APs delivering the dollars or the desk talking with the issuers about, and the issuers asking, saying, look, there's going to be like a $200 or $300 million create today, let's say. We can hedge that, right? So if there's a delay between when the demand occurs and when the coins can be delivered, someone can own that risk and someone can actually make money holding that risk if they want, right? So like if Bitwise or Invesco Galaxy or Fidelity comes into an OTC desk and says, we need X amount of Bitcoin, like we could just deliver it to them and take a equally short exposure to Delta, hedge our position while we wait for them to send us the cash and blah, blah, blah. So the market, in terms of outside of the ETFs, but the actual just spot and derivatives markets and infrastructure in Bitcoin trading has gotten very sophisticated. So we have plenty of tools. And I would say that has smoothed out a lot of this impact. Typically, the risk has now, when we do that, even though the coins haven't been delivered or bought yet or delivered to the ETF, or the cash hasn't come from the APs and settled, the delta risk has now been dispersed into the market typically by then. So it's not too bad. But there is a fixing window, like usually between 3 and 4 p.m., when actually all of this effectively happens. But if you know at 10 a.m. that demand today is huge, this is a big catalyst or whatever, that risk will be getting absorbed by the participants already in the form of agreements to deliver spot, but hedged in other ways. So like the market is sophisticated enough to bear even large inflows or outflows at this point.
So this authorized participant, Jamie Dimon has a view on Bitcoin, but JP Morgan is one of the big authorized participants, including you have others, Goldman's, Citi, Citadel, and Jane Street. So what do you think? When do these big banks officially start to custody Bitcoin and like kind of change the tone overall?
Well, I would say, first of all, watch what they do and not what they say.
Yeah.
Jamie Dimon has said a lot of very stupid things about Bitcoin over the years. He really has. So one of the things that lets JP be a authorized participant is the fact that they have cash create and redeem. And this is in the US, there's a variety of very silly things that have been done by regulators or not done relating to Bitcoin. Two of them are directly relevant here. One, the SEC the SEC and FINRA, who of course the SEC delegates plenty of regulatory authority to that SRO, they have neglected and in some cases prohibited broker-dealers from touching crypto assets. The SEC specifically claims that you need a separate license, a special purpose broker-dealer license, to hold crypto asset securities. But of course, Bitcoin isn't a crypto asset security anyway. But this lack of, in some cases, lack of clarity, in some cases, an actual prohibition, means that broker-dealers can't actually touch crypto and Bitcoin. And so those, many of the firms that, like our OTC desk, even Coinbase owns a broker-dealer. I remember everyone has tried to come in to the regulators and say, what do we have to do for you to let us do this in the way that we would how do we make Bitcoin flow through the pipes that already exist? And they've really not done the work, or like I said, in some cases prohibited that from happening. So Jane Street, Coinbase, they all have a broker-dealer and they're having to do the Bitcoin activity outside the broker-dealer. The big banks, first of all, are broker-dealers. All of them have broker-dealers. So that can't touch the Bitcoin. Then a whole sort of separate set of very stupid things that regulators have done around banks touching digital assets of any kind basically makes it impossible for banks to custody digital assets and Bitcoin. Specifically, Staff Accounting Bulletin 121, which is a non-binding guidance letter put out by part of the SEC. Actually, it's guidance for the accounting firms that oversee publicly traded companies. But, well, if you tell the big four accountants that they should they should tell their clients to treat digital assets this way, it does effectively become a rule on the public companies, and many banks are public companies. And what this thing says is that that you have to carry custodied Bitcoin on your balance sheet. State Street, I think, is the world's largest custodial bank, something like, I don't know, trillions of dollars on behalf of their depositors and clients. That's not on their balance sheet. If State Street goes into bankruptcy, I'm not saying they are, then those assets are not part of the bankruptcy, right? Those are owned by the depositors. They're separate. They don't carry them on their balance sheet. This rule requires that the Bitcoin be carried on the bank's balance sheet in the case of a publicly traded bank, which means that it now becomes subject to bank capital requirement rules. So for every $1 you hold in Bitcoin, you will have to hold $1 in extra cash also. So you can imagine, okay, I mean, if we're going to hold, $12 of Bitcoin, okay, that's not too bad. But what if you're an institution with $1 billion or $13 billion of Bitcoin? The bank's not going to, where are they going to get the $13 billion in cash to put next to their Bitcoin? So they effectively don't do it, right? It would be totally uneconomical for them to do it. The downstream effect is that everyone is custodying with state chartered trusts. And at this point, to be clear, the custodians have become amazing. But in general, you've got for millennia, maybe not millennia, for hundreds of years, the place that people custody assets is at regulated depository trusts and banks. And for some dumb reason, they won't let Bitcoin be custodied there. So these will ease, I think, over time, because also it just doesn't make any sense. That's just really quite stupid. Why not let them do it? Many have tried, none can really do it. And then I would also say there has been pressure from the banking-specific regulators. So the FDIC, the OCC, the Fed, they're all concerned about what would happen if banks held Bitcoin. I think the evidence is becoming overwhelming that nothing bad and plenty of good could come from it, but that's why.
Any sense on timeline of when this changes? We never know.
A different regulatory regime would probably take a different stance. So in some cases, that's elections or terms that expire. But also, I will say the U.S. House is taking action on SAB 121. By the way, you know who hates that regulation the most? The banks. They want to custody it. JP wants to be an authorized participant, and I bet you if they were told that they could custody it, they probably would, right? Like in the end of the day, if you have a product that everyone around the world in increasing numbers desperately wants, for whatever reason, and Bitcoin certainly is that, and you're in the business of offering and holding such products, then of course you want Bitcoin.
So in absence of banks custodying, currently all the ETPs are custodying their Bitcoins, predominantly with Coinbase and maybe some others. So how do you think about the risk of centralization here?
Yeah, there's definitely some concern about seeing all of this flow to one custodian. I'm not sure it stays that way in the future. If you're a provider, you're going to want to diversify to spread your risk. So I personally think this is just maybe what emerged straight out of the gate to get these things launched, and so we'll see how it goes. But the idea too of these companies co-opting or having some kind of pressure, I don't find very interesting because, again, going back to what makes Bitcoin unique, the token holders have no say or power over the network. Someone holding $1 billion of Bitcoin has no more power than me holding $10 of Bitcoin, right? And so I think that part's a little bit overblown. There's certainly some things to maybe be aware of just from like a risk perspective, or if somebody screws this up, that's obviously very bad. It's going to be ripple through and people will lose a lot of trust. But that's why it's so important to get custody right. And Fidelity Digital Assets, that's our main product, our bread and butter. It's a boring business until it's not. And so you hope it's always a boring business. And I don't think that there is that much of a concern, also because Bitcoin's so unique that there is the opportunity to self-custody at any time. So even if someone has their coins with someone, the fact that they can either sell it and then use it to buy it or just directly withdraw off an exchange keeps all these participants a lot more on their feet and honest, in my opinion. Just having that option there, I think, is really interesting and something we've never seen before with any other asset.
Yeah, I mean, I think Chris's point about proof of work coins versus a proof of stake coin, right? I mean, if you hold a large amount of coins, a percentage of the circulating supply in a proof of stake network, you literally have control over the network, right? The validating network is based on how much capital you own, not how much work you conduct. So that is a bigger deal. And you see this as a debate and constant debate and question and potentially problem in networks like Ethereum, which do have questions around this, because who controls the capital literally does control consensus, where in Bitcoin it's more complicated. So I agree, the risk is more about safety. I would also say, like, if you believe in, first of all, custody has become very sophisticated. So I think the risk is actually very low at this point that any of the major custodians, including Fidelity, would have any issue with this. It's managing private key material. Like there's set sort of standards for how everyone basically does it that's highly secure. So I don't think there's a real risk of loss. There's some technically down there, a little tiny. But it's really gotten a lot smaller. But if you believe that Bitcoin will be widely adopted or owned, then you should, let's say it even in the most aggressive utopian outcome where it's like as prolific and ubiquitous as the dollar or major fiat currencies, it's going to be everywhere. It's going, you have dollars in your fintech app, in your bank account, in your pocket, right, in your brokerage account, in your money market fund. You have cash-like instruments like treasuries, and right, there's so many versions of dollars. There's going to similarly, in my view, be so many versions of Bitcoin, and some of them will be custodied, others will be self-custodied, others will be perhaps at banks. I mean, one of the earliest adopters, Hal Finney, the recipient of the first Bitcoin transaction, wrote a blog post mere months after Bitcoin launched, saying that there would be a very good reason for Bitcoin banks to exist. So I think it's not all going to be self-custodied on a hardware wallet in my basement or in my self-custodied node. But it is unique in that you can do that, to Chris's point, but it is going to be everywhere. It's going to be at institutions. Let's hope it's eventually at banks. I think this, in the end, makes it much more entrenched and decentralized if it can be spread out to the systems and architecture of the world.
Yeah, I think to Alex's point, the experience for self-custodying Bitcoin is not great, and most investors, especially retirees investing in a little bit in Bitcoin, or just everyday investors or wealth management platforms who don't want to take on the risk of having to secure and custody Bitcoin on behalf of their clients. Like, the user experience for self-custody isn't great. So there will always be people and proponents of self-custody. I'm one of them. But there will also always be a demand for a more user-friendly way to access Bitcoin. That's why using a third-party regulated custodian that's in good standing, that holds the assets, segregated from the business's assets, is important, and it's why a lot of the spot Bitcoin ETFs, or most of the spot Bitcoin ETFs, chose Coinbase, because it's a publicly traded company in the US, it's regulated, it has a track record of custodying assets on behalf of clients for many, many years without any issue. And so as that continues, you have this kind of Lindy effect of using third-party custodians taking place. And I think the investors in a spot Bitcoin ETF are generally not going to be the self-custody maxis, and that's okay. There's going to be a broad spectrum of investors in Bitcoin and ways to store that Bitcoin. To Alex's point, it could be in a mobile wallet, it could be in cold storage, hot storage on your web browser wallet. There's all these different ways to do it, and so custody through a third-party regulated custodian is just one of those ways. And because of the legal structure and the regulatory burden of ETPs, you have to use a third-party regulated custodian. There is no, the risk of self-custody is too high to go a different route.
Great. So I want to talk a little bit forward-looking from here on. And volatility is something that still scares a lot of people, individuals, institutions, a lot of people. And we have gone through predictable cycles of 4 years of volatility in Bitcoin's history. So now, with ETFs presence, how do we think the volatility will it get smoothened out over time? Because it's easy for people to get access to Bitcoin through ETFs now, and there can be a lot of inflows. But as we have seen in the last few days, it can reverse also very quickly, where it can turn into outflows also very quickly. So does the volatility get smoothened out, or will it increase the volatility because it's easy to get and easy to get out?
I think it depends on the time frame you're talking about. So we just put a piece on our website just this week, so you can see the charts I'm talking about here. But zoom out, big picture, Bitcoin started at a 200 vol, annual vol level, and it's done a lot of this, but if you draw a regression line through it, it's continually sloped down. And I think that's just a product of it maturing and becoming a multi-trillion-dollar asset class. So you mentioned gold earlier doing the same thing. And so we actually have a chart in this report showing that once gold was once the dollar was depegged from gold and people could legally own it again, but so until the 70s, people actually weren't allowed to own it as an investment, it had to go through a price discovery process, and the volatility went way up. And then it kind of came back down, and then it actually went up again in '08 as it kind of went through a second price discovery process. And I think Bitcoin's following the same thing. It's going through this price discovery process where the volatility is part of it. You can't have volatility without the returns. You know, Parker Lewis, a famous Bitcoin educator, I love his line where he says, Bitcoin is volatile because it's scarce, but it's also valuable because it's scarce. And so you can't have one without the other. You can't take out the volatility without taking out its core value proposition. And so investors should embrace volatility. In our report, we actually talk about this. We show things like Sharpe ratio and Sortino ratio of Bitcoin versus S&P. Sure, it's more volatile, but you're more than compensated for it. You have a higher Sharpe ratio. And Sortino ratio, which is only looking at the downside, which is what most investors, especially retail investors or individuals, care about, that kind of stomach ulcer index of drops. Yeah, it goes through big drops, but again, you're more than compensated for it, and it's actually asymmetrically skewed, the returns, where there's more positive volatility. So it's experiencing volatility because it's ripping to the upside versus its volatility is going up because it's dropping. And that's one thing that makes Bitcoin very, very unique, this asymmetric return. So short term, I do think the exchange trade products could add to volatility because you've got a lot of, obviously, retail momentum kind of trading in and out of this. But long term, this is just another milestone on its road to financialization. And then you're going to get the derivatives and the futures. And a lot of academic research shows that once you have those markets, that also smooths it out because you're adding more participants, you're adding more ways to express information about the market. So again, long term, I expect that regression slope to continue going down for Bitcoin.
Great. And so looking forward from here, medium term, 12 to 18 months out, and longer term, base bull case, like how do you explain what's the outlook for Bitcoin in your opinion, given all the institution demands and all the dynamics that we are seeing? How's the outlook?
Yeah, I mean, I think we're very optimistic on the outlook. We've talked about a few of the dynamics that are at play here. There's a falling new supply going forward, and already a relatively limited remaining supply until Bitcoin hits its hard cap. There's increasing demand that will only continue to increase as more and more institutional investors and wealth managers who manage something like $40 trillion of wealth in America, as they start to access Bitcoin, add it to model portfolios that they just blindly allocate to when they do quarterly rebalancing, as they start to add it to their more aggressive portfolios, which maybe have, instead of a 1% allocation, a 3% or a 5% allocation. So there's this rising demand, there's this limited supply, and then there's this de-risking that's happened with the spot Bitcoin ETPs and with Bitcoin recovering from the last bear market, where I think a lot of investors around the world are looking at this as an asset that really is here for the long term. And I think that leaves us optimistic for the future of Bitcoin. I think we were just running a very simple market penetration study that said if Bitcoin penetrated 50% of the gold market, which is something like a $16 trillion market today, then the price per Bitcoin would be somewhere in the $400,000 to $500,000 range. So if you just play out these various elements that we have, rising demand, falling supply, this awakening that's happening to what Bitcoin can do to a portfolio, and you look into the future of the markets it could penetrate, I think it paints a very optimistic picture for the future of Bitcoin, whether that's 1 year, 2 years, 5 years, or 10 years.
I think that's extremely well said. I agree with that completely. I think I'll add some additional stuff, really less about that, but if think about the macro environment and how the geopolitical landscape is changing, I think the case for a non-sovereign fixed supply, totally inelastic supply, which also creates volatility to your point, the case for something like that is just getting stronger and stronger on a fundamental basis. So if the volatility comes down, then investors can take larger positions, right? Because high volatility, as you said, manage your position size. Well, if the volatility comes down and the liquidity goes up, then liquidity begets liquidity. So now, if you're looking at some macro event and you're saying, well, sell $1 billion of this country's debt and buy $1 billion of that country's debt instead, well, you can't really do that in a lickety split with, now you can, probably a billion you could do. But it, to be that global macro quality asset that can be used as an exposure either to or not to the fundamental idea of a non-sovereign currency, it needs to grow bigger, and it gets better and bigger as more liquidity, like it feeds itself. And so that it will become more useful as it grows bigger, as volatility comes down. But also, like I said, I mean, aside from that it's got these return potentials and risk characteristics, all of that's true. I think there's going to be many more fundamental reasons why people want to own it. I think you see it with gold now. It's finally moving. Sweet gold, you took so long to finally have a positive few months. But there's reason for that. Like, the world is very concerned about the national debt situations around the world, and including in the US. Treasury demand is declining, and yet deficits are at basically all-time highs. The United States is adding $1 trillion to its national debt every 100 days. Just during this talk alone, we added $200 million. Did you know that? Just to the national debt. What were you guys doing? You shouldn't have been adding 200 million. Get your stuff together. Well, unfortunately, the nation's governments basically can't. They're in such a tricky spot when it comes to fiscal and monetary policy that when you look at the programmatic, credibly neutral monetary policy, by the way, which has a payments network built into it, it can be stored cryptographically. I mean, it just looks so fundamentally interesting that I think beyond the pure return potential, you'll just see people start holding it for its fundamental properties more and more.
Yeah, I was going to go on the macro front as well, so I don't have anything to add to it. As well said. I'll just add to the fact that I don't think traditional finance and Wall Street has seen in many, many decades a true, as you said, credibly neutral asset that has no counterparty risk. Like that just hasn't existed before. And you have all these macro things going on where I think people are going to come to the realization of how powerful and valuable that is. And that I don't think that can be understated. And the other thing I'll just end on here in terms of outlook, we were talking about this last night. If you've ever seen that YouTube TED Talk, it's only a 3-minute TED Talk. It's many, many years old by now, but it's called How to Start a Movement or something like that. If you Google it, it'll come up. And it's got this guy who's dissecting a 1-minute video. And it's a video of a young man dancing wildly at a park or at a concert on this grassy hillside. And he's the only one out there dancing. And he says, this guy's trying to start a movement. And you think he's the one starting it. But as he goes through the video, he shows the most important person is the second person who joins him, because that person validates the first person. He's not crazy anymore. He's not just the one lone guy dancing as a crazy person that everyone around is just ignoring. Now the second guy joins, he starts motioning his friends over. All of a sudden, in an instant, there's this crowd and they're all dancing wildly. And I think that's the moment we're at right now. You have one company who some people, all due respect, thinks is the crazy person dancing. You've got one country, El Salvador, everyone thinks is the crazy country doing it. And so if we get that second one, I think that's the inflection point that we need to get us to the next level. So I think that's what we're at now, and we'll see how it plays out.
What an excellent way to end the conversation. I would like to thank all our panelists. Thank you so much for being with us today.
Yeah, great job. It's fun.